Hi, Robert. How are you doing today?
Hi, Gilbert. I'm well, thank you.
Great to see you again. So maybe you can start off by giving us an overview about your company, Greenfire Resources.
Greenfire is a growth-oriented oil sands producer in the Athabasca region of Western Canada, focused on the sustainable development of its Tier 1 assets using steam-assisted gravity drainage, or SAGD. SAGD is an enhanced oil extraction method where bitumen is heated and recovered from the ground using steam. Greenfire consists of a team of thermal oil experts who have collectively commissioned and operated most of the SAGD sites in Alberta, and the company is led by the president and CEO, Robert Loebach, and CFO, Tony Kraljic. Greenfire has current production of approximately 20,000 barrels per day and is targeting 70% production growth over the next 2 years to 34,000 barrels a day using established SAGD production growth and optimization techniques. Greenfire is publicly listed on the New York and Toronto Stock Exchange with a market cap of 560 million Canadian. The company is committed to prioritizing debt repayment. As of Q1 of this year, the company's debt includes 300 million US of senior notes due 2028, which Greenfire intends to reduce in the near term using 75% of excess cash flow until total debt is less than 150 million US. The company also has an undrawn 50 million revolving credit facility and 90 million of cash on the balance sheet. This capital structure and liquidity profile positions Greenfire with material financial flexibility as we pursue our production growth strategy to drive value for our shareholders.
Great. So for investors who may be not familiar with oil sands that much, can you tell us more about the Athabasca region? Also, the company operates Tier 1 assets in Hangingstone facilities. What really makes it a Tier 1 location?
Greenfire's Hangingstone facilities are located in Western Canada in the heart of the Athabasca region in the oil sands, which is the third largest oil reserves in the world. The company's Hangingstone facilities are underpinned by a Tier 1 SAGD reservoir, the best of the best, which positions and provides structural capital and operating cost advantages, as well as productivity and recovery benefits relative to SAGD assets held by most of our public peers. With operatorship of 2 of the 5 Tier 1 SAGD assets in Alberta, Greenfire provides public investors with pure play exposure to these differentiated and concentrated Tier 1 oil sands assets.
So usually oil sands project requires quite a bit of capital investment. So how do you be able to manage this and also achieve targeting your growth? And also how do Greenfire's reserves look like?
Greenfire's Hangingstone facilities were originally constructed by an international state oil company. The capital expenditure profile and risk profile for SAGD is typically front-end loaded to build major processing facilities and infrastructure. Greenfire's Hangingstone facilities are already constructed and producing, including pipeline infrastructure for diluted bitumen and diluent that can accommodate the company's growth outlook. Greenfire's consolidated a large, long life, and relatively low decline oil sands reserve base, which was previously conservatively operated, offering what the company believes provide ample opportunities for additional value generation. On a proved basis, the company has 183 million barrels of reserves, representing a reserve life index of 28 years with a net present value of 2 billion Canadian or 24 Canadian per share net of debt.
So what's the company's production growth strategy and planning for 2024?
Greenfire's strategy is to grow into the capacity of these existing plants by implementing what the team calls the SAGD playbook, which includes industry standard production growth and optimization techniques, primarily focused on drilling and surface facility optimizations to drive capital efficient production growth of 70% from current production levels to the facility's debottleneck capacity of 34,000 barrels per day. Greenfire's Tier 1 assets, strong balance sheet, and talented team position the company to continue to execute our growth strategy and drive further shareholder value creation, which is anticipated to support material potential free cash flow generation for debt repayment and position the company for future potential shareholder returns. In 2024, the team is executing the SAGD playbook to grow production 25 to 40% relative to 2023 to 22 to 25,000 barrels per day. Capital expenditures in the year will be 70 to 90 million, with about 2/3 of spending focused on drilling activities and the remaining 1/3 focused on infrastructure investment related to surface facility optimizations to augment water and vapor handling to support production at higher sustained rates.
So the Trans Mountain expansion project is in operations in May this year. So does Greenfire has any contract capacity with it? And so what does this pipeline expansion have any impact on Greenfire's future?
While Greenfire doesn't have any contracted capacity on the Trans Mountain expansion pipeline, the company has material exposure to a re-rating in Canadian heavy oil prices, with production 100% weighted to benchmarks that are linked to WCS differentials. With the Trans Mountain pipeline expansion project operational as of May, Western Canadian heavy oil producers are positioned to benefit from approximately 600,000 barrels a day of incremental export capacity to Tidewater, which could result in a structural tightening of the WCS differential over time, which would be supportive of Greenfire's free cash flow generation potential.
So what are Greenfire's sustainability initiatives?
Emissions are a cost to the company. Greenfire remains focused on cost reductions to ensure we maximize production and use energy as efficiently as possible. With our steam generation capability and emissions largely fixed, in the near term, the company is focused on reducing carbon intensity per barrel by growing production and driving operational and cost efficiencies.
Compared to your SAGD peers, do you think your company is trading at a discount right now? And what does the company need to do to address this discount?
We believe the company has strong fundamentals and positioning. Greenfire trades at a 55% valuation discount on a 2024 enterprise value to flowing barrel basis relative to the core public SAGD peers. We believe this discount is owing to Greenfire being a newer company with a more limited name recognition and public track record, as well as lower trading liquidity owing to a higher insider ownership. To address this valuation discount over time, the Greenfire team is focused on delivering its production growth strategy, targeting step change free cash flow generation, as well as engaging with institutional and retail investors to educate them on Greenfire's differentiated Tier 1 SAGD assets, our growth strategy, and talented team.
So really thank you for your time here today. We have gone through some really good content and information about the whole oil sands and the SAGD industry. Thank you for your time here with us, Robert, today.
My pleasure, Gilbert. Thank you. Have a great day.
Yeah, we'll talk until next time.